Okay, welcome everybody to tonight's lesson. This is Sami Abu Saad. I'm Director of Education at T3 Live, coming on with another lesson, and it's lesson 10, where to buy or sell anything, any moving instrument, whether it's stocks, bonds, Forex, futures, commodities, does not matter. Any tradable instrument that's traded in an open market. I'm going to teach you today where to buy. We started last time by talking about support and resistance, and today we're going to kind of continue that discussion. Before I get going here, just a disclaimer to let you know that trading is risky and that whatever we discuss is for educational purposes only. This is a standard required disclaimer that I have to disclose, that I have to share with you, okay? So make sure you agree to it. If not, please exit the video immediately. Okay, so as I always do, I give you kind of a review of the last week's lesson, and I do want to do that today because I got a flood of questions about the last two lessons, lessons 8 and 9, about support and resistance. It would be a very long video if I were to go over every single slide from the last couple of weeks, but I just want to say here that minor support basically is the support that lies at or just above what used to be resistance in an uptrend that got broken through to the upside. So usually a prior pivot high or a prior base. So when the stock pulls back to that area is a strong minor support area. Just like a ceiling becomes the floor. If you were look at the ceiling above you, if you were Superman and you were to crash through it, you would land on it. So that's the concept. Why does it work? There are four reasons in fact, but the main reason is the short sellers that shorted and didn't exit on the way up when the stock went against them. That's virtually every novice trader out there. They get the chance to exit at break even here. They get the chance to exit break even, and their covering propels the stock higher. Of course, professional traders know this. They add fuel to the fire by going long in that area too. There's also the sold out bulls, the bulls that were in it but got shaken out of it. They get the chance to re-enter a stock that continued higher without them at or near their original exit. If you want to get the full detail, make sure to watch the last couple of weeks, last 2 Tuesdays. The videos from last 2 Tuesdays. Minor resistance is the resistance that exists in downtrends, and it's what used to be support, the prior pivot low, becomes resistance on a retest for the same reasons that I discussed when I talked about minor support. So if you look at a chart just like this one or any other chart really, what was resistance, this was resistance, becomes support on a retest. This is now the resistance area. We crash through it, and then on the pullback it becomes support. Sometimes prices don't come all the way back down to it. Sometimes it stops just above it by a little bit, and that's because if you're down $4,000 here, down 3, down 2, down 1, down 200, you might say, well, and it starts to maybe move up a little bit, you might say, what the heck, that's $200, that's no problem, I got it, and then you get out. So they cover quickly before it even reaches the prior pivot high. So that's why minor support is at or slightly above the prior pivot high in an uptrend. And then in this case, it's based at the prior pivot high. So that's a base at support. In this case, minor resistance. So on the rally back to the bottom of that base, that's called minor resistance. Minor resistance here at the prior pivot low, okay, in a downtrend. Now, there's also major support and major resistance, which mostly exists in sideways trends. And major support is the retest of a prior pivot low. Okay, we don't want to be looking to play double bottoms like a stock that's, let's say, in a downtrend. Let me take out, let me just start maybe a new Word document, so I use it as a whiteboard. you don't want to be looking at stock that's downtrending and playing it long here because, oh, it's a double bottom. That would be a mistake because usually it continues lower. So major support mostly exists when the stock has already retested that area at least once successfully. Then you can start playing it. So usually the first, you don't play it on the first retest, you play it on the second and third and fourth, and the same with resistance, with major resistance. It's the area of the prior pivot high, but you don't play it. I'm trying to get to a real chart. You don't play it on the first retest. You play it on the second retest. So that's the first retest of the prior pivot high. You don't short it here. You start shorting it after the first retest worked. If it worked, then you can do it the third time, the fourth time, the fifth time, the sixth time, and the same with support. Okay, this is a pretty sloppy chart. Let me show you a different one. Here's a better one. So we don't short the first time the stock retests that area. We can short the third time, the fourth time, the fifth, right? And every other time after that. The same on the way to the downside. So here's the initial move, here's the retest. Now that it worked twice, then the third time you can play it. Fourth time, fifth, sixth, seventh, but this was kind of a higher low. Okay? Now that doesn't mean that major support only exists if you have a base. Sometimes, even if it's in an uptrend, you can find major support and play it at the bottom of the trend. For example, let's say a stock that is in an uptrend but basing. See this? You can pick it up right here. Pretend this is the rising 20 right here. You can pick it up right at the bottom, right here, even though you get a base here, but the stock is actually in an uptrend overall. So major support mostly exists in sideways trends, but it also does exist in uptrends. I said 2 reference points are necessary, but there are exceptions. This area can be considered major support despite having only one prior pivot low, because the prior pivot low was an area where the stock rallied really hard. So there are 4, you can add A, B, C, right? C, and then D. We'll add them in a minute here. So if the prior reference point was an area where the stock went climactic buy setup where the stock just ran out of sellers, then 1 reference point is enough. Okay, 1 reference point is enough if the rally that was produced was really significant, because when a stock rallies really hard, basically traders are rewarded handsomely. Rewarded traders always look to repeat their actions on the next go around. So if it's an area where a strong rally ensued, then 1 reference point is enough. You don't need 2. 1 reference point is enough if the new pivot, this area, it is solidified. Is that the right spelling? By something else, by a rising 20 MA, a flat 200 MA, or something else, such as sometimes we also have minor support coinciding with major support. Let's say we have, let's see, my annotation tool stopped working. Let me restart it. Okay, let's say the prior area was, we had a base here. We said a base and then a breakout and then a pullback. Well, that would be minor support also, in addition to it being major support. So if the new pivot or is solidified by something else, such as a flat 200, a rising 20. The 20 is most powerful when it's rising. The 200 is most powerful when it's flat. Minor support, etc., etc. Okay. D is 1 pivot is enough if there was some kind of a guerrilla tactic there, such as a breakdown failure. If prior low was an area where a significant failure took place. failure took place, such as a, a pro gap up, a professional gap up, pro gap up, right? A breakdown failure, BDF. So one pivot would be enough, okay? So that's major support. That's major support, but in this case, we also have two reference points. Does that make sense? That's a huge rally. One pivot is enough. Positive memory caused by many traders being rewarded handsomely. Rewarded traders always repeat their action. Look to repeat their action. So major support mainly exists due to a self-fulfilling prophecy. Okay? Major resistance, the same thing. It's an area where a lot of traders that played long got hurt, and now their pain is relieved. They get their break even, they get out, and the stock drops. But not only that, the group of sellers at top number 2 dramatically increases, making it an opportunity for a potential short trade. Why does it increase? Because you have professional traders that also short at the prior top. They know what's going on and they look to take advantage of it. Okay, these are more examples. I'm not going to go over each and every one of them. If you want to get the full detail, make sure to review last week's lesson. But I do want to say that I did get an email. Well, which one is stronger, minor support or major support? And I can't compare the two and tell you in a vacuum which one is stronger, because it's like comparing a dog to a cat. I've seen cats that would that are stronger than dogs, right? And I've seen dogs that would tear a cat apart with their paws, right? So you can't compare the two. They're different, but it is said that minor support is stronger than major support because minor support exists in uptrends, and that's indicative of strength. In fact, when a stock that's in an uptrend pulls back to major support, that's already a violation of the uptrend, because the uptrend, the definition of an uptrend is higher highs and higher lows. So if you retest the prior pivot low, you are by definition, the stock by definition failed to make a higher low. So minor support is said to be stronger because it exists in uptrends. Major support exists mostly in sideways trends. And if the stock is in an uptrend and retested major support, then it's a sign of weakness. You might be saying, well, can you give us an example of major support in an uptrend? And the answer is absolutely. Major support in an uptrend is the pivot that makes a new high on the daily chart. So if this pivot makes a new high, then this becomes major support. So for example, you have an uptrending stock. Let's say this is the daily chart. See this? That's not a major support area. Once this becomes a new high, then this becomes major support. That's major support also. Okay, does that make sense? No major support yet, makes a new high, this becomes major support. And these other pivots are not major support. Does that make sense? So in an uptrend, the pivot that makes a new high is considered to be an area of major support. And if a stock pulls back to the prior low all the way, that's a sign of weakness. All right. Another reason why minor support is said to be stronger than major support is because at minor support, let me ask you, why does minor support work? What's the premise behind it? Why do traders buy minor support? Can you guys tell me? We're in the middle of a coaching session for the strategic day trader room members, and I broadcast some of these lessons, the Tuesday lessons at least, to social media. So feel free to comment in the video comments, or if you're with me here in the room, just let me know by typing in your answer. Why does minor support even exist? I already told you the answer several times already. No? Minor support exists because traders that shorted, or that's the main reason, get stuck and they get their break even back. The ones that shorted the prior top, they get their break even back, and that pushes the stock higher. So it's short covering. So why do they cover though? Because they get relieved. They get their break even back. So traders don't usually have to do to whereas major support, let me back up. Major support exists because not because traders were in pain, but because they got rewarded and they repeat their actions. They get rewarded again. It's like a thief. He goes to this place. He always finds it a store. Always finds it open. I mean, and nobody on watching. He's always gonna go back there, right? Or a house, breaks in it once, finds all kinds of good stuff, good things, and he knows that the owner of that house never locks the doors. Of course he's going to go back. The same in trading. Major support exists due to a self-fulfilling prophecy because traders got rewarded and then and they want to get rewarded again when the price retests that area. Minor support exists not due to some positive memory, but due to some painful memory. And in trading, we say traders don't have to do anything unless they're in pain. When they're in pain, when they're stuck in a trade, when they get back their break even, I mean, they will cover, they'll exit the position, and they'll feel super grateful. Oh my God, thank you, I got back to break even. So minor support exists due to a painful memory. And traders don't have to take action unless they're in pain. Major support exists due to a happy memory or positive memory. And when it's positive memory, that's strong. I mean, that has strong emotional connotations, but it's not as strong as somebody being in pain. When they're in pain, they have to cover. When they're not in pain, they don't have to buy. Some traders might say, well, I got lucky once. I don't want to push my luck. Does that make sense? And they might not buy the prior pivot low. They might not, because they might say, well, I don't want to push my luck. I made a good amount of money today. I don't want to push my luck. So major support, again, traders don't actually have to buy. They do buy often because they get the chance to make money a second time. Okay, but for those two reasons, it is said that minor support is actually stronger than major support. All right. Okay, so for today, we're going to talk about where to buy. All of this was just a review. For today, we're going to talk about where to buy or sell. There are three main areas where you should buy anything. Again, stocks, commodities, bonds, futures, Forex, doesn't matter. Anything that's tradable in an open market. And the main three areas, if the stock is in an uptrend, are at minor support, which we already covered, the rising 20 period moving average, which we haven't covered, okay, where to buy, but that's where to buy, right, at the rising 20 period moving average, or at the 40 to 60% retracement level. If we're talking about where to sell, it would be the same thing, but it'd be at minor resistance, the declining 20, right, and the 40 to 60% retracement also, percentage of the prior move. So today we're going to talk about the rising 20 period moving average. Okay, so let's read a little bit here and then we'll go over some chart examples. In general, there are four dominant moving averages that we use. The 20 and the 200 should be on all charts. In addition, either the 8 or the 40 should be on the charts to produce the railroad tracks, which we'll discuss shortly. The 8 and the 20 should be used on the 1 or 2 minute charts for fast moving stocks. The 20 and 40 for slower moving stocks, or the 15-minute chart. The 5-minute chart goes either way. Base your choice on the movement of the stock. To tell you the truth, I put the 8, the 20, and the 200 on all my intraday charts. The 20, the 8, the 20, and the 200 on all my intraday charts. On the daily, weekly, monthly, I use the 20 and the 200. The 8 is a shorter term moving average. All simple moving averages, by the way. You can use exponential, no problem. But if you use exponential on the 8, make sure it's exponential. The 20 is exponential, the 40 is exponential, the 200 is exponential. Okay? Make sure you're consistent across all time frames. So this is a short-term MA. The 20 is intermediate and it's major. It's it's short-term to intermediate, and it's important. That's the most important moving average. It's the most watched. That and the 200, but the 20 is much more useful because the 20 tags price. It follows price. The 200 is usually lags price and is useful if price drops into it. I did videos on how to use the 20 and the 200. Feel free to check them out in my playlist on Facebook or YouTube under the Strategic Day Trader playlist. I did like an hour-long video on how to use the 20 and the 200. And in the 40s, an intermediate term moving average. The 200 is a long-term moving average, okay, and it's major. So the 20 and the 200 are the key moving averages. Now, moving average concepts, rising major MAs represent positive market action or strength. Falling major MAs represent negative market action or weakness. The sharper the slopes of the major MAs, the stronger or the weaker the trend, and the less sustainable it is. The sharper the moving average, also the less sustainable it is. It usually doesn't last that long. As long as the stock remains above its major MAs, except when it goes climactic, its action is said to be bullish. During a strong stage 2 means an uptrend. During a strong uptrend, retracements tend to halt near their rising MAs, 8, 20, and 40. During a strong stage 4 means downtrend. During a strong downtrend or really weak downtrend, rallies tend to halt near their declining MAs. Following penetrations of the moving averages, when the moving averages actually break, when price breaks through them a little bit, pullbacks to the now broken MAs become very likely. Moving averages are superior tools in stages 2 and 4 when the stock is uptrending. In stages 1 and 3, when the stock is going sideways, their importance is greatly minimized. There's only one use for moving averages when the stock is in a sideways trend. The 20 MA is the most dominant and is used by all T3 trained traders in all time frames. So this is what we're talking about, right? When you have a buy setup, this is a buy setup pattern, which I actually have not covered with you. I have not talked about the requirements for a buy setup pattern. When you have a buy setup pattern, in this case a buy setup with a COG or changing of the guard, a bottoming tail, above average volume, minor support, the prior pivot high, and a narrow range bar at the 40-60% retracement. That's an 80-point play. We rank the plays. So when you get a buy setup at the rising 20, that's almost a near perfect buy setup. Okay, the T3 buy setup combined with a bullish rising MA is one of the most powerful T3 trading combinations in existence. In our view, there's no other combo. What I mean by combo here is no other amplifier. Okay, there's no other amplifier that's more accurate or reliable, so make sure to learn it. This powerful amplifier represents the core of the T3 trained traders' focus for longs. Traders who spend the majority of their time mastering this one tactic alone will dramatically increase their odds of becoming a master trader. This is the one. At times when the trend is extremely strong, the 8 MA will be the one to focus on, but this state usually does not last long. Here's some examples, right? The stock is in an uptrend, and where does it stop at? It doesn't even reach the 20. Why? Because it's so strong. Does that make sense? But look, this pivot, this pullback stops at the rising 20, at the minor support. It also has a narrow range bar and a COG. These are all amplifiers. If you have these, usually the setup, basically the more amplifiers, the better the odds. The setup will usually work. But notice that rising 20, rising 40, and railroad tracks between them. When I see railroad tracks like this between the 20 and the 40, or the 8 and the 20, I close my eyes and buy the stock. Well, first I buy it and then I close my eyes because it's as good as money in the bank, almost. Look at this also, railroad tracks, rising 20, pulls back to the 20. Not the most decent pullback, so in this case could have played it just as a breakout. Okay, and then it pulls back here. So above the last bar's high, stop under the low, and target would be the prior pivot high. That's a buy setup at the rising 20. This was a transitionary buy setup right here. In fact, there was a buy setup already there. So what do I mean by transitionary buy setup? Let me show you. Okay, so when stocks are downtrending, here's the downtrend. The moving average is usually going to be, the 20-period moving average is going to be on the other side. And then when they start to base, okay, moving average is going to catch up and then flatten out. Once it starts to point up like this, then you know the stock is about ready to break out. And that's what happened here. We got the first buy setup and then the second buy setup. So there were actually two. One right here wasn't quite good, and then one right here. So if you look at the previous example, that's exactly what happened. We got the first one, which wasn't that great, but the second one right at that curling rising 20 MA. I call it the halt, HALT, because the stock halt, the moving average halts the stock from continuing lower. Does that make sense? Halts the stock from continuing lower. So that's the first indication of a trend change, and it's a high quality buy setup. And if you can get it right here, then you basically got it at the point where the stock was metamorphosing, transitioning, transforming itself from a downtrending bear stock to finally an uptrending bullish stock. So you'd be getting it at the point where the stock would have the highest reward to risk it will ever see. This is basically the best place to get it. You might say, well, what about this place? This is the best place to get it. Yeah, but that would have been, that would have been just lucky, getting lucky. Because every time you bought it in a downtrend, it would have failed, continued lower, right? So that's not an area where a professional trader would just buy it. That would be just lucky. This is a good area to buy. Does that make sense? With really high odds. Same here, you get the pullback to the rising 20, 45-degree 20. Beautiful. Buy above the last bar's high, stop under the low. Target is actually the prior pivot high, but that's too close. You know it's going to go through it, as it did, right? So notice that the rising 20, but rising 20 usually coincides with minor support. This is the beautiful thing about today's lesson, is if you use that 20-period moving average, it's not just a line on the chart. It usually also, if you look to the left, it usually also coincides with minor support and coincides with the 40 to 60% retracement percentage, which we're going to talk about next week. Okay, this pullback right here to minor support and the rising 20. This pullback right here to minor support, a little bit of support, and the rising 20. Does that make sense? And then the declining 20 is the same thing. I mean, the sell setup is the same thing when you have a declining 20, but to the downside. It's the same thing. In this case, it's a T3 sell setup with a bearish changing the guard, a topping tail, above average volume, at minor resistance, that's minor resistance, at the 40-60% retracement percentage, and at the declining 20. Each point gets 10, each one of these amplifiers gets 10 extra points. So we have 1, 2, 3, 4, 5, 6. So that's 60 points, plus the sell setup is given 20 points. So that's an 80-point setup. Is almost perfect. Not quite perfect, is almost perfect. This is a sell setup at the declining 20 and minor resistance. Okay? A sell setup at minor resistance, declining 20, plus a topping tail and a narrow range bar. And that narrow range bar is also called a COG, a changing of the guard bar. That's and reversal time, 3 o'clock reversal time. That's a 90-point play. I mean, if that's not perfect, I don't know what is. Target is the prior pivot low. After 2 bars in your favor, you start going bar by bar until your target is met or you're trailed out. Okay, that's a 90-point play. Basically, picture perfect. Okay. This is a buy setup to the rising 20 with a COG, or that's not a COG, just a narrow range bar at minor support at the 12 o'clock reversal time and at the 40 to 60% retracement. Do the math. It's a 70-point play, I think. Okay. This is just so beautiful, unbelievably beautiful, because that's a buy setup, a transitionary buy setup. Can you actually find another buy setup? Was there another buy setup that you can spot on the chart? Anybody? Anybody? Was there another buy setup that you can, if you look at the chart? Yeah, right here. That's a buy setup at both the rising 20 and the 40. So just absolutely beautiful. 2 buy setups. Okay. And notice that the stock is transitioning. See that transitioning. If somebody's asking me what's a COG, changing the guard, it would be unfortunately a bit too long to explain what that is, but it's basically just, I'll tell you what it is. It's the green bar that forms after 3 or more red bars without taking out the prior bar's high. So this would be a changing the guard bar because it's a green bar that formed without taking out the prior bar's high, without triggering the setup. Did we have a COG? That's a COG, bearish COG. Make sure, Noel, if you have access to trading the Pristine method class, make sure to take that, to review that class, take the home study, because that material is all explained in it. Okay, trading the Pristine method class. It's really the gold standard for education. Okay, and for those that are listening, watching this on the internet, you can find. I'll drop a link, I guess, for trading the Pristine method class later on in the description of the video. All right. Um, Another beautiful pullback to the 200, to the rising 20, to minor support. I mean, so beautiful with lots of narrow range bars. A famous Chinese proverb says a picture is worth 1,000 words. Well, I don't know if it's a Chinese proverb or not, but it's just a saying. This one had the potential to be worth a few $1,000s for those who knew how to read the T3 trading concepts that appeared on this chart. The 20 and the 200 in this chart show why they command huge respect in all time frames. But again, I love this buy setup because the stock was also transitioning. How do I know it's transitioning? Look at the flat 20 and started to curl, right? That means is just starting the uptrend. So if you catch it here or on this pullback, you're basically catching it at the beginning of that uptrend. Beautiful, that's the best. Again, novice trader will say, no, that's not the best place to buy it. That's the best place. Well, how did you know it was going to bottom there? It was still pointing down. The moving average was still downtrending. Our job is not to try and catch the bottom. Our job is is okay to try and catch the bottom when we have sufficient information to to determine that it is the bottom. And that's when we have that transition A. Okay? All of this and a lot more obviously is taught in Trading the Pristine Method class. My job here is I'm just giving you kind of the cliff notes, okay? And I hope you enjoyed today's class. If you have any questions, please reach out to customer service at customerservice@t3live.com, or you can call them at 888-998-3548. Feel free to also check out the link in the description of the video for this incredible offer where you can join me for the next 30 days in the strategic day trader room for only $49. This is for new members only. Those that are already in the room or have subscribed in the past don't qualify. This is just for somebody who's never been part of the room. The strategic day trader is the only room that won the best trading room award for 2 years in a row. Okay, as voted on by the trading public. So we are, it's one of a kind. Okay, and once you get in there, once you try it out, just try it out for 30 days for 49 bucks, basically almost free, almost. Then we challenge you to find a better room. Okay. Hope again you enjoyed the video, and I'll talk to you guys next week. Have a good one. Take care, everybody.